Hey everyone, welcome to the KE Report and another daily editorial. This time chatting with Dana Lyons. Dana Lyons is a fund manager and editor of the Lyons Share Pro website. We're going to be focusing on this market pullback. A bit too early to call it a crash, to call it a bear market, but the S&P just in a matter of a couple weeks is off almost 7%, and that momentum does seem to be picking up steam. Yes, there's a lot of political noise out there, but Dana is very good at just focusing simply on the charts and sharing what his models are telling him about breadth, about all kinds of other components that play into markets and the momentum side of markets. So Dana, looking at any of the broad averages, look, we're in correction mode. We haven't had a 10% correction in almost a year. Sure seems like we're going in that direction now, but Dana, is now the time to panic in these markets?
Thanks, Corey. It's never time to panic, obviously. It's best to try to stay unemotional as much as possible. And the best way to do that is to have objective criteria, objective set of indicators for guiding your investment decision making. So, we have objective quantitative models that we've used for a long time that really guide our orientation towards the market in terms of, okay, how aggressive or defensive do we want to be? And a lot of it, as we've talked about in the past, has to do with breadth and internal indications and which way the broad market, which direction are most of the stocks within the whole market moving. So we want to try to stay on that side of things. And as you mentioned, obviously in a corrective mode right now. Is this the time to panic? The time, if you're going to panic, you typically want to panic when others are greedy. So back after, just rewinding a little bit, just to go through some of the signals that our models have given. We had a nice breakout following the election. Some of those broader small cap averages we're waiting for to break out did indeed break out and enjoyed about a nice 1 month run higher. And then things turned on a dime. And to us, just looking at the charts in early December, we would not have been that concerned. But under the surface, our models and our indicators really started deteriorating pretty rapidly, which was a surprise to us, given the recent breakout. And it was a good heads up when our main risk model did turn bearish in early to mid December, that we want to start getting pretty defensive, and we did so back then. Then we had some stabilization. Certainly large cap averages were able to rally back into new all-time high ground, but the key was that our risk model did not even turn around positive, much less make it back to previous highs. So even throughout this year, we've been pretty defensive. We've basically gyrated between moderately defensive and extremely defensive. So into that move into, February, as especially the large caps had kind of made their way back into all-time high ground, we started getting much more defensive again, given the fact that our models were not turning around. So towards the end of February, we reloaded. On the short side, got very defensive, and now we're seeing the indications of why our models did not turn around, why the broad market was still headed lower. So at this point, it's too late for investors to panic. And as a matter of fact, we have been a lot of those shorts that we put on at the end of February. We're starting to cover a great deal of that exposure now.
Well, Dana, I think it'd be interesting to dive in a little bit more to how your models work, because one of the factors you look at is breadth and like the overall participation in the market. Like, how is something like the equal weighted S&P doing versus the weighted S&P? But the other thing you look at is excessive excitement and froth or excessive pessimism, because they're actually counterintuitive. When everybody's very excited, when there's too much participation, when everybody is saying, let's be bold, let's get out there and buy this thing, that's usually where the top is. When everybody's getting depressed and they're freaking out and they think it's volatile and the VIX is going higher, that's actually the time when you want to start looking at buying, because those are the turns. So maybe speak a little bit more about how you factor these into your quant models.
Yeah, absolutely. sentiment readings are an invaluable tool for investors. And again, if you can maintain an unemotional state and maintain a cool head and just read the data, read those quantitative indicators, you'll be much better suited to make sound investment decisions and take advantage really of others' emotions. So, they're basic mechanical things that change throughout the course of time in the markets. But one thing that remains consistent is human nature. Investors will react the most based on price movement. So the more prices go up, the greedier they get, and the more bullish they get. And like you said, when they're excessively bullish, that's the time to get defensive, like in early to mid-December. And then conversely, when you do see measures of fear and panic in the streets, that's when you want to step in and start doing some buying. And we are finally seeing a little bit of that, not on the longer term indicators. Longer term indicators are obviously still excessively bullish, but those are not really timing indicators. We like to look at some shorter term sentiment readings, some put the call readings, activity in the inverse ETF market, various other surveys that are more short term in nature. And based on those, we're seeing a healthy degree of bearishness, which means, again, like you alluded to, a lot of people have sold already. A lot of people are hedging already. And given the fact that there are less people that are apt to sell, and whether they've sold already or they're sufficiently hedged that they don't need to sell into a new breakdown, that's when the market's more apt to bottom and at least some sort of a short-term bottom and a turnaround. So that's when we want to be covering some shorts like we've been doing and do some buying. And you also alluded to another key sentiment indicator for us is the volatility market, and specifically what we call the term structure of volatility. So the short versus the longer term contracts in the volatility market. For example, the VIX that everyone knows is a 1 month expectation of volatility. And when that rises, typically it's below levels of the 3 month volatility index. And when the 1 month rises above the 3 month, that's a good indication of investor panic and fear. And when that happens, it's usually a good indication or has been a solid and reliable indicator that you're more near the bottom than you are near levels where you want to be panicking or selling.
Dana, I'm curious if you're seeing any rotation of money into any areas. We've heard that this is a much more defensive market right now. Bonds have gotten a bid depending on what term you're looking at. Gold continues to do quite well, but then also the US dollar, which sometimes is a safe haven. Boy, oh boy, that's down 3% already this month. That's down over 5% just in the last month from early February. So are we seeing rotation into any sectors?
You've seen, especially as some of these growth stocks have pulled back. And by the way, I'm not sure that growth move is over. There's plenty of areas that have held up reasonably well despite this recent growth scare. So I'm not sure that you can make a blanket statement that, okay, throwing out all the growth stocks. But you have seen some of the defensive sectors that, after the move late last summer into the fall had fallen by the wayside as growth recovered. Now we're seeing a flip-flop, and we've seen a recovery in areas like utilities and consumer staples and those areas like that. You're also seeing a lot of money pouring into Europe, which has broken out to all-time highs, specifically on a hedged euro basis, but also some of those markets unhedged. So that is certainly an area of opportunity. I would not be chasing here. I'd love to see some sort of pullback in the Eurozone towards those breakout levels. I'd be certainly more than willing to add exposure there. And then in the U.S., maybe our favorite sector right now, which really bounced back to almost all-time highs in some areas in the last week, has been financials, which has been consolidating several areas in the financial arena or sector have been consolidating right up near all-time highs, have been extremely resilient. So we've been buying some more financial exposure into this recent pullback over the last few days.
Yeah, Dana, you're not the first person to mention that they've been noticing those trends from growth to value. Not that people believe growth is over, just that some of those defensive sectors like consumer staples, like financials, like utilities have been getting the bid. Just kind of shows you where investors' mind are at. A lot of people have even noted that Berkshire Hathaway has continued to get a bid, and that's usually a kind of a safe haven name for folks. But when I listen to you talk, I think it's important to remind people that are listening the value you place on looking at things in different time frames, because you could still be short-term bearish, but medium-term bullish that the market, again, has that blow-off top. But then even longer term, still bearish that we haven't corrected the excesses. Even the 2022 correction did not get rid of the excesses in the market. So maybe talk about the difference between short-term, medium-term, and long-term outlooks.
Absolutely. And the key comes down to, and the durational perspective comes down to just making money. I think it was Ned Davis's book was called Being Right or Making Money. And you can be right about, for example, you laid out the long-term bearish or pessimistic outlook for stocks, and you could be dead right about that over the next 15 or 20 years, that we make little or no net progress. But if you have it blow off top in the interim over the next year, and the market jumps up 20, 30, 50%, you don't want to be sitting that out. So you have to have shorter term perspectives, shorter term investment guidance at the same time to help with, timing some of those shorter term moves. So as you alluded to, our main models are on an intermediate term basis or time frame, which to us is typically anywhere from 2 to 6 months. Maybe sometimes it's longer when you get in a established trend, but for the most part, signals are generally 2 to 6 or 8 months. The down moves are shorter. The up moves or buy signals are generally longer. But that time frame typically provides moves that are substantial enough that we want to try to take advantage or avoid relative to other time frames. If we're day trading, then that's a lot more difficult. We're not trying to get every 2, 3, 4% move in the market. And again, on a longer term time frame, if we were just trying to time those cyclical or even secular moves, then we're going to be sitting out just monster moves on the sidelines while we're waiting to be right. And sometimes you get proven that you're not right, and you've sat out for 6 months, a year, 2 years, or longer, waiting for your thesis to be right, and then it's proven wrong, and then you've missed a lot. So that's the key to that durational time perspective, is really your ability to make money.
Yeah, that's a good point there, Dana. I do want to go back and revisit your comments on that European trade and how, yes, fine, you're not necessarily buying at these levels, but waiting for maybe a pullback, another entry opportunity. Do you sense, or are your models telling you anything about tide change in terms of international markets potentially picking up steam, potentially being able to outperform the U.S. markets on a longer term time basis?
I mean, it's certainly possible, but we've been saying that as long as, almost as long as I've been in this business, for decades and decades. Europe especially has been underperforming the U.S. basically since, the 90s. So it's, again, that's another, to Shad's point, if you're playing that turnaround mean reversion game in Europe, you've been waiting for, 30 years or so. So it certainly looks like that is underway now. Whether that persists is, again, you have to have objective criteria to let you know or give you an indication whether that is likely to persist, or whether this is just another one of those head fakes that we've had throughout the last few decades, and the U.S. takes over the reins again. So again, to have a shorter term, or what we call an intermediate term perspective that tries to keep your money in those intermediate term trends and then helps get you out when those trends change. But certainly you use the word due. Europe has been due for decades and decades, and looking there at their fiscal situation, they're obviously they're a mess over there, and I have no fundamental reason for objectively saying that we should be pouring a lot of money into Europe, but sometimes that doesn't matter, and you just go where the money is flowing. So right now we're looking for, as you mentioned, opportunities into some weakness, if we get it, to kind of reallocate some more money there.
How are you looking at a market like China? Because in addition to comments on Europe kind of surprising people, especially their financial sector lately, some people have been playing China as a contrarian jurisdiction and market that's starting to get some legs to it.
Yeah, we don't love contrarian investing. I mean, from a price perspective, as I alluded to, contrarian investing from a sentiment perspective has been very reliable, meaning, okay, buy more when sentiment is extremely bearish and vice versa. We don't like to necessarily buy markets just because they're down a lot or oversold or due to take over leadership reign. So that's not really our MO. I know some people have that strategy and can successfully navigate that. That's not our MO. So something like China, we've seen fits and starts. We haven't seen enough evidence, as far as I'm concerned, to convince me to really put any significant or any allocation at all towards that market right now.
Okay. Dana, we'll wrap it up here. Very interesting comments. And look, I think a level-headed outlook on these markets. Yes, it's in correction mode, an overdue correction. Who knows how deep that correction is going to go, but there have been some shining lights, as there always are in these markets. We'll see when chatting with you over the next couple weeks and over the next few months when this all turns and when there might be some better opportunities in a wider range of sectors like we went through a whole lot of last year. If you want to learn more about Dana's website, visit the Lyons Share Pro website. I will post a link in the show notes. Dana, always great chatting with you. We'll chat again in another couple weeks.
Sounds great. Always a pleasure, guys.